MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show and Happy New Year, Danielle.
Hey, thanks, Jim. Happy 2019 to you.
How happy will the people be who have borrowed to buy stocks and other securities?
Yeah, that's a point that people have been writing me about in the last little while. Just reminded me of the issue and how important it is to discuss, because so many people get their advice from financial sales firms or product sales firms like broker dealers, that sort of thing, financial planners. And unfortunately, a favorite playbook to boost their sales is to recommend that people borrow money so that they have more capital to, quote, invest. And whether they take these mortgages against their homes or whether they take HELCOs against their realty, and some of them are using margin accounts where they borrow against the securities that they have. You know, when prices are going up, that can look like a magical formula where you will gain more as prices rise. When you use borrowed funds, you gain more of a percentage increase on your original capital. But unfortunately, they never take into account the down cycle. And of course, the down cycle is when the prices start to free fall, like we've been seeing already in the last year, and the debt doesn't move. So what ultimately happens in these things is it makes you extremely more exposed to the down cycle. So leverage can be catastrophic on the way back down, where your losses are much more than the overall fall in the assets because you use borrowed funds. And people have been writing, Investors Group is a big proponent of this. Wells Fargo, Morgan Stanley. I mean, a lot of the banks have advanced HELCOs in Canada. It's a lot of the, I remember, in 2008, next door to our office was a Money Concepts franchise, which was, infamously profitable for the founders of that office. And of course, they had put everyone into these levered loans, during the expansion in 03 to 08. And then when the market started dropping, everything imploded. These people lost a lot of money. They panicked. They sold at the bottom, and then they still had the debt. So that franchise actually ended up going out of business because of the lawsuits that followed, but that doesn't repair the damage that's done. And I've been getting a lot of people writing about how, they either are experiencing that right now, where they're getting margin calls, which means you have to put in extra cash when the asset values are falling, or you have to sell things to increase the cash buffer as prices fall. So both things are, it's like akin to taking savings out and throwing them on a bonfire in your backyard. It's extremely stressful. It's highly inappropriate for just about everyone. And yet this is what the firms do as their how to goose their own sales. So it's not too late for people, if they're in those products or in that approach right now, to, frankly, write me through the blog. I will give you a second opinion, or, it's not too late to revisit and review, what's in your best interest at this point. Because the market cycle is certainly into a significant downturn, Jim, but we could be half to a third through the ultimate decline cycle that we've set up for this time. And that's, I think, the thing people have to understand. I know that the sales firms have been sending out letters saying to people, there's, quote, volatility, don't panic. And of course, I'm not telling anyone to panic. I'm telling people to be proactive in controlling the damage to your net worth. Because if you just wait and, take that that sort of placating letter for the first few months of the downturn, ultimately most of those people will panic near the bottom after it's too late to really do anything, and then they'll look to sell, or they'll be forced to, as I say, to cover the margin debt that they have to pay back. And so that's a terrible way to manage your life savings.
I saw a guest on one of the financial networks say, "Oh, it's too late to do anything now. You have to ride it out."
That's what they always say, you see, because their modus operandi is to keep everyone fully invested at all times so that the firm fees are not ever reduced by people going to money market or cash. And that's why they're ultimately set up in direct contravention or directly opposed to the best interests of their clients, because their clients simply don't have the timelines or the emotional strength or liquidity to withstand major downturns. And this one has been a long time coming. We certainly deserve a major bear market. And already, things. The other thing in Canada, and this is something else I was writing about the blog, is that the same people who are owning the most expensive realty in places like Toronto and Vancouver tend to be the same demographic, socioeconomic, and age-wise, who are holding the bulk of the corporate securities. So they have, they came into 2018 because it's been a long extended cycle. People were, attracted back like bugs to a light late in the cycle, whereas most were running for cover in 2008-9 when valuations finally came down and there was opportunity. They were liquidating, then they run for cover and they stay away from the markets for the first few years of the upcycle. They finally capitulate, go back in. This is all classic. They come in late cycle. And in mid-2018, they had the highest exposure to equities of any period since the tech wreck top in 2000. So those people are the same ones that are now facing, falling home prices in Vancouver and Toronto, which are the most socioeconomically significant areas in the country, because of the wealth of the households is higher than average than other places, and their consumption has been a large part of the driving. The real estate fees, transactions, the sector itself, as well as the levered consumption off real estate, have been a huge part of the growth that the Canadian economy has seen in the past decade. And so now that is, it's, kind of like everything else, looks good on the way up, looks terrible on the way down. And because people are that much older, they're going to have to look to raise cash as their balance sheet is getting hit both on the realty and the securities side right now. So they're going to need to raise cash, and they're going to want to sell their securities to do that, because their real estate, I think they're going to find, is a lot less liquid than they imagined now that sales have fallen. So in Vancouver, the latest data is that the home sales volumes fell in 2018 to the lowest level since 2000. So, the price trends typically follow sales volume at a lag, and Vancouver tends to lead Toronto. So, I think that both of these, both falling security and realty prices and sales in both of those major centers are going to sort of exasperate one another in 2019.
We'll have more with Danielle Park right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the Pink, symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Welcome back. We're speaking with Danielle Park. Danielle, recent comment was that they believe there's an 80% chance of recession. Other people put it at 60 or 70, but it's always on the negative side or the positive side, I guess. when you're picking a large number like that. Was it due, and can this be a good thing?
Yeah. So, well, the ISM, there's many, many indicators. It's never a precise art to tell when we're in recession. The fact is we won't know till we're probably already coming out of it when it's officially declared. But things like the US ISM Manufacturing Index, it dropped by more than 5 points in December. And the only time it's ever done that since 1970, a decline of that much in a month-over-month basis, we've already been in recession. And the last time they did it, that happened was in October of 2008 when we were in fact already in recession. And the Shanghai Index, which is the Chinese stock market, has already fallen 30% since January. Some of the leading sectors like the Apples of the world that, were the star turns in the expansionary phase have fallen 37% just since October. So the stock market is a leading indicator of the economic cycle. And when you have a very highly levered economy and populace, as I mentioned, people with too much debt who have borrowed actually to buy some of these assets, the stock market can be one of the most important variables that brings on recession, finally triggers it, So this is all indicative of the fact that we're probably either already in recession or very close to it, and that it may indeed take, a year or two before we're out of the woods here, the stock market being a leading indicator of that. So the stock market tends to start down into the bear market several months before the recession actually is officially declared, sometimes 9 to 12 months in advance. So you really can't wait for that recession indicators for everyone to predict there's going to be a recession before you look to reduce your risk. First of all, because most never declare or suggest there's going to be a recession, and because it's a very imperfect indicator. So what we really have to watch is leading things like the unemployment index, which recently was at an all-time low. And typically that is a precursor to recession because, once you can't go to zero, there can't be, zero unemployment in the economy. And once you're down, around 5% and less, you're getting very, very, close to the end of a cycle typically. So the good news is, and this is, this goes back to how do you want to play these crazy cycles that have been so magnified by the leverage and the reckless policies of the past 20 years. You can either play them by being long always, which is the mainstay recommendation of the financial industry, and most people are sort of set up with that approach. And then you have to go through these vicious declines, which, as I've said, the past two are more than 50%. This one is likely to be equally as bad, and then take years to recover thereafter. Or you can raise your liquidity well in advance of the down cycle and be patient enough to keep your principal safe, because as you alluded to, the happy news or the good news that comes on the other side of this is much lower prices. And when you buy assets at much lower prices, you're doing so with a fraction of the principal risk that you do when you buy them at very high extended prices. And not only that, the dividend yields that you get are so much higher when you buy these assets at lower prices. So just one example, another cyclical indicator has been the junk debt, which is the worst, lowest quality corporate debt that is sold to investors, was yielding under 6% for quite a while in this cycle. Typically that's what government treasuries have yielded in past cycles, and they're a fraction of the risk of the corporate debt market. Now we're talking about the junkiest junk, the poorest, credit quality that tends to have default rates of about 30% when you get into the recession. So just in the decline that's happened in the last, just since October, in the value of those corporate debt, the corporate bonds that are falling, already the average yield on junk debt has gone from 6 to above 8%. So I'm not suggesting anyone jump in yet, but just by waiting, not only have you prevented capital loss, but you're setting yourself up to buy these things with yields that could be above 10% by the time this cycle completes. And then that yield is something you can collect thereafter for, many years in the expansionary cycle. So even if the next expansion is slow and sideways, indeed, because of the weight of the debt, because central banks are approaching it with the least ammunition that they've had in modern history, because rates are low and balance sheets remain bloated, because of the fact that demographics are against, the housing market at the same time as the security market and all these factors together, it's very likely that we're going to get big price declines and a much slower recovery. In the realty cycle, it's very typical to see 10 years plus of prices basically just stagnating, going nowhere. It's called the consolidation phase, consolidating for all the excesses of the prior peak. But during that time, again, if you can wait to pick up these securities, even if prices stay flat to stagnant for a multiple period of years, if you're picking up great income, whether that be in the form of yields off dividend-paying stocks, which you buy near the low as opposed to hold near the top, you can get dividend yields above 6 to 8%. In the corporate debt market, you can get them above 10%. Preferred shares will be yielding more than 5% again. All these things that have been sort of toxic, not really investment grade at all in the past few years because they were so overvalued, are going to come back into the realm of great investment potential. And that's a really exciting opportunity. And that's worth waiting for, quite honestly, because as I say, the alternative of, throwing your money into the pot at any price is just totally counterintuitive and counterproductive for the real world life cycle of a human being, where, your savings have to persist for the rest of your life. And, many people that have approached retirement, I've been getting mail again recently of people who had, tried to retire in at the peak of the last couple of cycles, in 2000 or in 2007. And what they ended up doing was having to go back to work near the bottom of the cycle. Once they realized they'd been improperly positioned going into it, they lost a huge amount of their savings, and now they're having to go back either to the same career and restart, or a completely different job just to try and make ends meet. So again, these cycles are extremely volatile because of the conditions, and you need to calibrate your own response in terms of how you're going to manage your way through it.
The last recession saw massive layoffs, but one of my guests suggested that perhaps we won't see that this time because it was so hard to get the employees that they have now. They know after a recession, those people won't be around again because there's a declining workforce.
Well, I think that is a problematic argument for two reasons. One is that we know the bulk of the job gains which have come in the past decade have been in the lower paying, sort of fast food working kind of jobs, and in realty and related sectors to, consumption retail around levered loans off of real estate. And so we've already started to see both a spike in bankruptcies in Canada and a spike in defaults, as well as layoffs beginning in the real estate sector. So it's the most, because it was the source of so much employment growth in the past decade, as that sector slows, it's going to have a disproportionate impact on employment in Canada as well. So I think, although demographically you've got this bulge of people that are moving towards 65 and 70 years old, the baby boomers, and they will want to be moving into retirement, if they don't manage their risk exposure coming into this cycle, and if they're still fully long equity products here, I suspect they are not going to leave the workforce in the way that people are expecting, or indeed many of them will be coming back to the workforce looking for jobs. And at the same time, as I say, the sectors that were the biggest job creators in the past while will go into a contraction phase, which has already begun. And so I think that that's why, when people have as little savings as they do set aside in liquid cash deposits, they have very little tolerance for any kind of interruption in income. And I think that's what sets us up for, they have to pull in spending, and that has a knockoff effect to more job losses in a retail sector, retail dependent economy like Canada is right now. So I think that's the problem. It's where the job growth has been and where we're now going to lose it, which has the biggest impact on our numbers.
So not unusual here where I live, a restaurant that's been in business for 7 years closing its doors because they said there just isn't the business anymore.
Yes, we've seen a downturn in eating out, in restaurant sales. In it's not just households that have done this so poorly this cycle, who have managed their risk completely opposite to how they should have done it, which should have been as they got employment again or as businesses picked up coming out of the last recession, would be to build up savings, pay down debt, get debt free so that you have a lot of liquidity coming into the next downturn so you can ride out any interruption or decline in income, but also, be available to take advantage of buying opportunities that present. But because they've done that wrong, we're that much more vulnerable than this cycle. And the other cohort who has done it exactly wrong is the corporate sector. Even the large companies like, as I say, the Apples of the world, the IBMs, the Microsofts, even Berkshire Hathaway, was buying back its own shares recently, So, to give you a sense of the numbers there, the largest corporations have spent about $5.1 trillion, both of their income, cash flow, and borrowing money to do it on buying back their own shares in the past decade. And this is the most destructive financial policy that has pretty much ever been, because they have a notoriously bad record for buying when prices are high and cash flows are rich, and not buying when prices are low. So Apple itself had, imploded $9 billion of capital just on the money they spent in the first 3 quarters of 2018. So they spent about $63 billion buying back their shares for lack of anything intelligent to do with the money, like long-term investment or, job creation or compensation for the rest of their employees. No, instead they just buy back shares to try and make shareholders happy for a little while because it tends to increase the price. But as shares begin to fall, it becomes abundantly clear that they've just literally wasted $9 billion of liquidity because those shares have fallen, as I say, 37% since October. They're down 8% just today, and that's just one example, right? So all these large companies that have been basically wasting the expansion by piling money into assets that can implode have not set aside enough cash and liquidity to do intelligent things or to be, to manage the business cycle in a sort of low volatility way. And that also makes our economy more vulnerable because now we've got, which engine is going to fire here when we've got the consumers on their back foot, the real estate sector suffering, the corporate sector suffering, and governments already with a lot of debt and central banks already near record lows. So there's just no clear way to quickly fix any of this. And in a way, that's a good thing because quick fix tends to lead to no lesson learned. And, it was just a decade ago that central banks in Canada, the central bank in Canada and CMHC had increased the amortization rate. If you remember, Jim, mortgages underwritten by the Canada Mortgage and Housing Corporation used to be a maximum 25-year amortization. And just over a decade ago, they decided it would be smart to make that 40 years. At one point in just before the last, when the U.S. housing market started to implode in 2006, Canada had gone to interest-only CMHC-backed loans, 40-year amortizations. And so that was exactly the wrong thing to do at the wrong time. And I'm afraid that tends to be the way policy goes. Policy tends to be, set up for exactly the wrong thing at the wrong time. And because they've made so many mistakes over the last 20 years in doing it this way, we now are so vulnerable to this third next cyclical decline. But as I say, the good news is that it's going to, wipe out a lot of real reckless behavior. It's going to teach people hard lessons. But on the other side of it, for those who can be prepared, it is going to be an opportunity that we haven't seen really since the 01-02 bottom, when, markets really trended sideways for a few years, but there was great value to be had and we were buying lots of equities at that point with great dividend yields and a fraction of the risk. And we did that again for a short time in 2009-10 because prices spiked so quickly after that. Values didn't stay very reasonable for very long. I think this time we're going to get an extended period. But the trick is not to be jumping in too quickly here because let's not forget that bear markets have very significant monster rallies, 500 and 600 point days, both down and up, are typical of a bear market. So people can too quickly think, oh great, it's going back up. Either convince themselves not that they won't take risk off the table or convince themselves that they should buy more. And I think you really have to let this thing make a durable bottom before you start doing any of that.
We'll have more with Danielle Park right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, is the world trying to wean itself off plastics, especially one-use plastics?
Well, yes. So you and I've talked about this in the past, Jim. At the beginning of 2008, China, who had been accepting about 45% of the world's plastic waste for the last many decades, so it was a huge stockpiler. We would just, create all this non-recyclable packaging and ship it over to China, where they stockpiled it in massive landfills. A small percentage of it has been burned, but the problem with incineration is, of course, that it sends all these toxic fumes into the atmosphere and really completely negates any benefit of trying to recycle. So what's happened is, since China put the gates up, so to speak, and said, hey, we have nowhere else to put this stuff, we can't keep taking the lowest grade and single-use plastics anymore, it's been piling up on this side of the world and in many of the developed worlds where it's primarily being made from our consumption. And that's actually a good thing. I thought at the time when China said that was actually an essential part of what needs to happen to turn the tide here, because as long as we can go out of sight, out of mind, of course, humans tend to not pay attention to things. But in the last year, because of the running out of places to put it, so to speak, you've got now people aware. First of all, National Geographic did a big article in the last year about how 80% of plastics are just going into landfill and waterways around the world. They're not actually being recycled. Only about 9% of the total plastic ever created has been actually recycled successfully in the world. The rest of it has just gone into waste. So all these blue box programs, or, those of us who think we've been diligently separating and sending our recycling off, it's a fantasy, because it actually hasn't been happening. It just goes to trash. Now, part of that is because we are not being careful enough in how we're sorting, and we're allowing too much contamination, whether it be food or multiple types of plastics are being used in packaging that can't actually be broken back down again. So there's a bunch of reasons why it's not working the way people assume that it is, or achieving the amount of recycling that they assume that it is. But the good news is, because of now people are waking up to that, they're refusing. They call it plastic attacks, consumer activism, which I myself have been doing in the past year. I tried desperately to avoid packaging. I've made a whole bunch of changes in our household and family and office to reduce, and we've been successful in doing that, in, just not buying things that come in plastic. But in some cases, you literally have no choice as a consumer. You go to find a product and it's like, no, it only comes in this huge plastic container. So I've started just leaving the plastic container with the checkout, just saying, okay, well, thanks. I can't take this home, because if I take this home, I have nowhere to put this other than into the landfill, and I'm not down for that. So what's happening is lots of consumers have been doing that. And so as the containers start piling back up on the retail operations, they go back to the package producers and say, hey, this is not okay. We don't want to have all this stuff piling up on us either. And suddenly there's pressure being brought to bear on the producers to rethink their packaging. So it's it's an important step. Regulation has a long way to go here in terms of forcing and banning certain kinds of packaging, forcing change. The profit margins that corporations have taken for granted because their costs have been so low on their packaging, because the full cost accounting of the harm they're inflicting on the environment has not been taken into account, of course. They don't consider, the harm to the oceans and waterways as in any way a cost of their doing business. And so it's piling up on municipalities and governments, which of course we taxpayers are struggling to cover all the expenses. And another major factor which is underappreciated is the extent of consolidation in corporations in the past many years. There's been basically no antitrust action that's taken place for the last 20 or 30 years. And so every sort of consolidation that any industry has wanted to do has been allowed by government overseas and regulations. And so these corporations have just got bigger and bigger, and that's been the case in the waste management sector as well. So, many of the competitors in past times are now amalgamated into one big producer, and they're now increasing, of course, dramatically the cost of dealing with this waste, because as that can't be cheaply sold to a developing country, they're now saying, okay, we have to find other places to store this, and they're hiking the cost to the municipality, just as municipalities are coming under pressure for all sorts of things that need paid out of the tax bill, out of the tax base. So I think all these things together, it's going to be a painful adjustment, but on the other hand, it's essential. I always say if the line of credit doesn't get cut, people often just keep spending their brains out. Well, if that extending of plastics to developing countries could be seen as a line of credit that allowed us to continue with destructive policies and behaviors, and now that it's been cut off, to a large extent, that's forcing us to get smarter and wiser with our decisions and our consumption. And ultimately, that's what we have to do to make the changes necessary.
I remember people made fun of my grandmother for taking her own string bag to the grocery store. Not so anymore.
No, well, our grandparents were wise, not because they were worried about environmental impacts for the most of the rationale was about cost savings, right? What was cheaper and prudent and frugal for the household was to reduce, reuse, and recycle wherever possible. And in many ways, the consumer, the credit bubble enabled all sorts of mass consumption, sort of mindless consumption, really, that we're now, suffering the debt weight from, but also the habits that people have developed in the throwaway society are now coming back into review. And that's also a very positive thing. We've been able to reduce our energy consumption and therefore our bills by about 40% in the past year, just in our house and our office, as well as reduce our plastic waste coming off of our, what we're consuming by about 2/3. So it's quite feasible to do it. And it's in our individual best interest to do it, both in terms of cost savings, but in terms of just having, sustainable policies.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
And again, you had an offer for people who were worried about their portfolios?
Well, because I've been getting a lot of mail from people, and some of them, are reporting that they're in very dangerous situations right now, and they're suffering already the emotional and psychological trauma of watching their savings drop, or of having loans that are against these assets that are falling. I just said if you're, looking for a second opinion, or you'd like someone else's input that's not in the sales side of financial products, by all means drop me a note, and I will try and be useful or offer some suggestions or recommendations just in terms of how they might, reduce their risk and sleep better at night.
Danielle's website, jugglingdynamite.com. You're listening to HowStreet.com radio. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. If you have any questions for our guests like Danielle, you can send them as well to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.